Hello everyone, welcome to IAS Baba's 60 days rapid revision series for Prelims 2022. This is day 22 and today we are taking up economic topics again. So these are the topics we are going to discuss. The first is the money multiplier effect. So here is like if we have 100 rupees within us, so it is not that the actual 100 rupee is under circulation. So it is much more than the 100 rupee which is in the actual circulation inside the economy. Say for example, if we keep 100 rupee in the bank will keep 10 rupees and then it will give the 90 rupees as a loan to others. And again, if this 90 rupees, if someone takes it and if he deposits in another bank, so again there that bank it will keep 9 rupees and it will give the remaining 81 rupees for the circulation. So totally, say for example, if we have 1000 rupees, out of these 1000 rupees, so the actual money that comes under circulation is 2439 rupees. So that means it is not the actual 1000, much more than that. So this is money multiplier effect. So friends, here mind you, like the economy means the bank and the customers both are included. So there was a question like if I withdraw some X amount, so what is the net change inside the economy? No change will be there because so bank and the customers both are the same. And then come to next, digital currency. So here the Reserve Bank of India will issue digital currency in the next fiscal, which will be called the digital rupee. And then the central bank digital currency uses electronic record or the digital token. And then the digital rupee will allow users to transfer the purchasing power from deposit accounts into smartphone wallets. And then so the other countries which have experimented in the digital currency is like in 2020, so Bahamas issued a digital currency, and China, so it is one of the largest economies which is working with the digital currency. So here friends, it is like how this digital currency is different from a cryptocurrency. So the cryptocurrency is the mined currency and it is a non-fiat currency, but the digital currency is the fiat currency that is recognized by the Indian state. So this is one reason. And then how this digital currency is different from digital payment. So your Paytm or Phone Pay, so wallet, so how it is different. Say for example, here the numbers are being paid in Google Pay and Phone Pay. So if you are paying 25 rupees, so you will type 25 and you will send it. But in the digital currency, that is not so. So there you will send the two 10 rupee tokens and one 5 rupee token. So mind the small difference between these two. Then come to next, the repo and reverse repo rates and the CRR. So we begin with CRR. So cash reserve ratio. So it is a specific part of total deposit that is held as a reserve by commercial bank. So it is mandated by RBI, but obvious. So it is like it is a reserve amount so that the banks do not run out of money, and it is decided by the Monetary Policy Committee. Earlier RBI used to decide, and now this MPC. And here if CRR is low, so the liquidity with the bank increases, and which in turn goes into the investment and lending and vice versa. So it is like if CRR is low, so then the money which is in the locker or which is in the reserve, so that will be taken up and given as loans. And if it is higher, so the external money will be sucked and it will be put into the reserve. So as simple as that. Then come to next, the repo rate and the reverse repo rate. So many of you had asked me a doubt like, so if the repo rate and reverse repo rate, if both increase, what happens? If both decrease, so what happens? So we discuss both of them here. So repo rate can be defined as an amount of interest that is charged by the Reserve Bank of India while lending funds. So if a bank, so if it is taking loan from the RBI, so what is the interest that has to pay? So that is the repo rate. So definition we all know. So here if the RBI increases the repo rate, so that means the banks have to pay more interest. So if they have to pay more interest, they will not take loans from the RBI. So if they are not taking loans from RBI, they will not give more loans to the investors or the customers. So that means higher the repo rate. So that means lesser the money that is infused into the economy. So if the repo rate is increased, so additional money will be sucked off. Okay. So the decrease in the repo rate. So decrease in the repo rate means so low interest that the banks have to pay, and at this point of time more and more loans will be purchased by the banks from the RBI and that will be lended off. So lower repo rate means more credit facility and more infusion of money into the economy. Now come to the reverse repo rate. So here the reverse repo rate is the rate of interest that is provided by the RBI. So while borrowing money from the commercial banks. So here it is like the RBI is giving the interest. So now if the RBI raises the interest rate, so if it is raising the interest rate, so the banks will come and deposit so much of money into the RBI So if so much of money, if it is being deposited into the RBI, so this money is not going into the economy. So that means the rise in reverse repo rate is the sucking of excess of liquidity. And now the reduction of the reverse repo rate means, so here the RBI is not giving so much of interest rate. So that means no bank is interested in keeping the money into the RBI's account. So that means more and more infusion of money into the economy. So here both the rise of the repo rate and the rise of the reverse repo rate, so both are sucking out of money from the economy, and reduction of both means infusion of money into the economy. Then come to next, the SLR. The statutory liquidity ratio is the minimum percentage of deposits that a commercial bank has to maintain in the form of liquid cash or gold or the securities. So here it is like to maintain the liquidity. So this is different from the reserve. So reserve means, so that is the safety for the bank, but here it is not the safety for a bank, it is the safety for the liquidity. So that means if there is a cash crunch, so some liquid cash should be there, so that we will distribute it to the customers as early as possible. So likewise, and here it is basically the reserve requirement that the banks are expected to keep before offering a credit to the customers. So that means if I am giving you the money, so that means if someone else comes and asks me money, so I should be having the liquid cash. So that is the simple concept here, and SLR is fixed by RBI again. And here if the bank fails to keep this SLR, so RBI can penalize. Okay, and then the current SLR is 18%. Then come to next, the marginal standing facility. So that refers to the rate at which the banks can borrow overnight funds from RBI. So overnight emergency it is, and the banks have to exchange the securities with RBI to avail of the overnight credits. So here the banks have to pledge the government bonds or any other sureties or any other securities, so that they have to buy, they have to take the loans, and the maximum credit a bank can avail through the marginal standing facility is 3% of the total deposits. So this is the quota. So only this much they can take, that too by keeping the securities, by pledging the bonds. Then the banks can use the securities under the SLR quota without paying a penalty, as it is an emergency situation. But if it increases this 3%, so now penalty has to be paid. Then this will shield the banks from the volatility of overnight interbank interest rates. So that means if RBI is not giving the overnight loans, so now they have to go and purchase the loan in the market. So in the market they have to pay the interbank rate, that means in terms of LIBOR or in terms of Sonia. So they have to pay the interest, and then they have to purchase loans. So again this is a shield that the RBI is giving. And then generally MSF is higher than the repo rate, so we know that, and the MSF, so it is 4.25% currently. And then come to next, the shadow bank. So shadow bank is a banking activity that takes place outside the traditional banking sector. So shadow banks are those institutes that do not collect deposits but still provide loans. So only the loan giving institutes. So examples are the special purpose entities, NBFCS, hedge funds, so all these. So they won't take deposits but they give loans, and then these institutions function as intermediaries between the investors and the borrowers, thereby providing credits. So this is a shadow bank. And then weak bank. So weak bank is the one whose liquidity or solvency is impaired or will soon be impaired unless there is a major improvement in its financial resources. So a weak bank means that is in the verge of insolvency. So the problems of weak banks: poor governance, then rising NPAs, so all those things you already know these. And then the bank run. So what is a bank run? A bank run occurs when large group of depositors withdraw their money from the bank simultaneously, so based on the fears that the institution will become insolvent. So this is a chain reaction. If someone out of fear, if they remove their account, so that will trigger for others to remove, and now more and more removal happens, so that will trigger more and more people to remove again. So here we have one more thing, that is the silent bank runs. So silent bank run means the people are withdrawing money in the online, so online mode, they are not going to the banks actually. Then come to next. So here the RRBs, regional rural banks, so they were set up as government sponsored regional based rural lending institutions under the Regional Rural Banks Act 1976. So they are statutory ones, and they are financial institutions which ensure adequate credit for agriculture and other rural sectors. So not only for agriculture, even others. Then RRBs are jointly owned by central government, state government and the sponsor banks with the issued capital share of 15 50, 15 and 35 respectively. Then RRBs are required to provide 75% of their total credit as priority sector lendings. So 75% is huge. So that means it is a welfare approach. So most of the funds they have to give by priority sector lending only. Then RRBs can also set branches for the urban operations also. So not only for the rural, so even for the urban and semi-urban areas, so they can set up their banks. Then come to next, development banks. So they have been set up to provide medium to long-term finances or loans at subsidized interest rates to various critical sectors like agriculture, housing, infrastructure, industries, etc. So it is like promotion of development. Then they do not accept deposits from the public but raise finances through government infusion of capital. So government will give the capital to them and then access to capital market through the issuance of bonds. So concentrate on this. So they will pledge the bonds or they will get the government grants. And then the nature of loans given by them is medium and long term, whereas the other commercial banks, so they will give only short term loans usually. So these are specified and specialized for giving long term loans only for businesses, that is only capital loans. Then the merchant banks. Merchant banks are a type of non-banking financial institutions. That is, the non-banking financial institutions are the organizations that facilitate bank-related financial services but does not have a banking licenses. So this is the one. And then merchant banks provide financial consultancy services, only the aid and advice. Then they advise firms on fundraising, management of the initial public offer of the firms, then underwrite new issues. So all these facilitating demat trading. So all these advices are given by the merchant banks. Then come to next, the NABARD. So the National Bank for Agriculture and Rural Development. So it is responsible for the development of small industries, cottage industries and any other such village or rural projects. So this is the bank of banks and it is a statutory body established under the NABARD Act 1981. It prepares district level credit plans to guide the banking industry in achieving these targets. So mark this as important. So they will have the plans for every district. Then it supervises cooperative banks, regional rural banks and helps them integrate to the core banking solutions. So here the NABARD is the sole financer of the cooperative banks and regional rural banks. So that's why they have a supervisory role also. So when I am giving money, I have a right to inspect you also. Then SIDBI, Small Industries Development Bank of India. So SIDBI is the principal institution to finance the MSMEs, the micro, small and medium sector enterprises in India. And it is a statutory body set up under the Act of the Indian Parliament. So this is also a statutory body. And then currently the shares of SIDBI are held by central government and 29 other PSUs. Okay, so mark these. So PSUs are also holding some shares. And then come to next, cooperative banks. A cooperative bank is a financial entity which belongs to its members who are at the same time the owners and customers of their bank. So here customer themselves, they are the owners of the cooperative banks. And cooperative banks in India are registered under the State Cooperative Societies Act or the Multi-State Cooperative Societies Act. So these are the acts. Then the cooperative banks are also regulated by the RBI and governed by the Banking Regulations Act and the Banking Laws Cooperative Societies Act 1955. So these are the various laws and they have multiple regulators. So any bank need not be having a single regulator. So multiple organizations can regulate them. Then cooperative banks are owned and controlled by the members who democratically elect the board of directors. So here democracy, that is paramount because the customers are themselves the owners. And then the DCC banks, that is the District Cooperative Central Bank, is a cooperative bank operating at the district level in various parts of India, and it was established to provide banking to the rural hinterlands with branches primarily established in rural and semi-urban areas. So mark this as primarily. So this word primarily was once given in the UPSC prelims. Then in terms of short-term credit delivery to the agriculture sector, the DCC bank delivers more credit in comparison to scheduled commercial banks and regional rural banks. So here this statement also was given and we went with a gut feeling that so the scheduled commercial banks are huge and how can these DCC banks, they can overtake the scheduled commercial banks, but actually they are overtaking. They are giving more loans than the scheduled commercial banks, especially for the short-term credit delivery. Then the one of the most important factors of DCC banks is to provide funds to the primary agricultural credit societies. So for agri societies, they are giving loans and these banks are collectively represented by the state apex central cooperative bank for each state, and this bank, the apex bank of the state, acts as the ultimate bank and the apex body for the DCCBs in each state. And then they are regulated by the RBI and the Banking Laws Cooperative Societies Act 1955. Then come to next. So the various kinds of NBFCs. So here we have various classifications. First is on the basis of deposits, that is the deposit taking NBFCs and non-deposit taking NBFCs. And then on the basis of their asset size, so which have more assets, so which have more paid up capital, so they are considered as systematically important NBFCs. That means they are powerful and they will not bog down, they will not become insolvent so easily. Then non-systematically important, so those which can go towards insolvency. Then asset finance company, so here some of the example are automobile, tractors and machineries and heavy industrial equipments. So these asset finance companies, they will give finances or loans to purchasing these assets, so that's why the name. Then loan company, so here we have the LIC Finance Limited, then the PNB Housing Finance, etc. So they can give loans, so not only for the purchasing of assets, so for other purposes also they can give loans. Then investment company, so here we have IDFC and HDFCs and also some mutual funds. So these are the investment companies. So they are ready to invest in any of the capitals, venture capitals or any others. And then systematically important core investment companies. So here at least 90% of these total assets are held in the form of investments in shares, stocks, debts, etc. So that means systematically important means, so they should be strong enough. And then core investment company means, so they are investing only in the companies. So corely they are investment banks. And then the infrastructure finance companies, so the GMR Infrastructure Limited or Hindustan Construction Company, so for the road construction or the rail construction, so they will finance. Then microfinance institutions, so here the Bandhan Financial Service Limited, then Ujjivan Financial Services, so microfinance, so they will give micro loans. And then infrastructure debt fund, so they raise funds for long-term infrastructure projects through bonds. So these are various NBFCs. So NBFCs is a ocean, so there are various kinds of banks and this is a brief insights on all of them. Then come to next, the capital risk weighted asset ratio, so CRAR. So this is also known as the capital adequacy ratio. It is a ratio of bank's capital to its risk. So here the CRAR is decided by the central bank and the bank regulators to prevent commercial banks from taking excess leverage and becoming insolvent in the process. And Basel III norms stipulated a capital to risk weight asset ratio of 8%. And in India, the scheduled commercial banks, so they have 9%, and the public sector banks, so they have a higher capital adequacy ratio of 12%. So here simply it is like, if I am giving 100 rupee loan, so that means 12 rupee, so that should be given to the safest persons. So that means out of 100 rupee loan I give, so 12 rupee will come for sure. So definitely they will repay back. So that is the capital 1, that is the tier 1 capital. So likewise, so if I say 12% as the capital adequacy ratio, that means, so this 12% is the safest one. So if at least 12% is 100% sure, so then remaining 50 rupees will be 75% sure, and then the remaining 50 rupees will be 50% sure. So likewise, the capital adequacy ratio will go in crude. So for us in detail is not required. For us the conceptual clarity is required. Then the higher CRR a bank has, so better is its capitalization. So that means, so instead of 12, if I have 15, that means 15 rupees will come back. Or if I have 25, that means 25 will come back for sure. So higher the CAR, so more is the credibility of that bank. Then come to next, Ubharte Sitaare Alternative Investment Fund. So the Ministry of Finance, so she launched the Ubharte Sitaare Alternative Investment Fund to facilitate debt and equity funding to export-oriented MSMEs. So it is only for the export-oriented MSMEs and it is an alternative investment fund. So it is like the investment fund, but it is not in the banking sector. And the fund is expected to identify the Indian enterprises with potential advantages, but which are currently underperforming. So they are potential, but they are underperforming and they are unable to tap their latent potential to grow. Then the scheme provides support through equity, debt and technical assistance. So all these things will be provided by this Ubharte Sitaare. Then this scheme also has the green shoe option of rupees 250 crores. So what is a green shoe option? It is like a green shoe option is an over allotment option in the context of initial public offering. So that means, so it is a provision in an underwriting agreement that grants the underwriter the right to sell the investors more shares than initially planned. Say for example, any company, if it has planned to issue 100 crores of share, so now the alternative investment fund, so it can say that no, go ahead with 150 crores. So that remaining 50 crores, I will give the surety for that. So such 250 crores of green shoe option, so that is available under this, the alternative investment fund. Then the fund has been set up jointly by the Exim Bank and the SIDBI. So mark these as important ones. So these are some of the features of Ubharte Sitaare. Then come to next, the Financial Stability and Development Council. So here the Financial Stability and Development Council is a non-statutory apex body under the Ministry of Finance. So it is an executive body. And then the Raghuram Rajan Committee on the Financial Sector Reform. So this committee proposed this FSDC. And then who are the members? The Finance Minister is the chairman of FSDC. Then the members of FSDC include the heads of the financial sector regulators, that is the RBI, then IRDA, then SEBI, then PFRDA, and other members are Finance Secretary, Chief Economic Advisor, and Secretary of Department of Financial Services. So these are the members. So just we will have a look at, because FSDC was once asked in the prelims also. Then the functions. So the body envisages to bring in the financial stability. They will discuss about the strategies to bring financial stability. Then the financial sector development. Then inter-regulatory coordination. So all these. Then no funds are separately allotted to the council for undertaking this activity. So it is just a think tank. So nothing funding undergoes in this. Then come to next, the Transport and Marketing Assistance Scheme. So this scheme was launched by Ministry of Commerce and Industries for providing financial assistance for the transport and marketing of agriculture products and to boost exports of such commodities to certain countries in Europe and North America. So mainly the transportation and marketing of agri. So that is the aim of the scheme. Under the TMA, government reimburses a certain portion of freight charges, that means the transportation charges, and provides assistance for marketing of agriculture. And here the rates of assistance have been increased by 50% of the exports by sea and 100% through air. So if you are exporting through the sea, so 50% refund of that will come from the government, and if you are exporting it through air, so full 100% refund will happen. Then TMA will be reimbursed through the regional authorities of DGFT. So the Directorate General of Foreign Trade. So that is the nodal authority which will reimburse or refund the money. Then input tax credit. So here it is the tax that a business pays on a purchase and that it can use to reduce its tax liability when it makes a sale. So these complicated definitions are not important. So here it is like the input tax credit means, so for example, the tax you pay whenever you purchase the inputs, so that you can claim it back whenever you sell that product. Say for example, so for making one pant, you are purchasing some cotton, and for that cotton, you are paying some taxes. And whenever you sell that jeans, so you will reclaim or you will get the credit of the tax amount which you have paid for purchasing the fibers or the cotton. And here a business under the composition scheme of GST, so they cannot avail for the input tax credit. So if the GST composition scheme is going on, that means the GST is already giving compensation to you. So that means the input tax credit will not come into picture. Then the input tax credit cannot be claimed for personal use. Okay, so that means you have the availability of the input tax credit only if you are manufacturing a good. So if you are using that good for the personal use, so no input tax credit. Then come to next, as much as 80% of the total GST liability is being settled by the input tax credit, because most of the inputs you are purchasing and most of the tax you are paying for the inputs. So that means so that 80% will be reimbursed. So the name of that will suggest more and it will give more rather than the actual definition. Then the Service Export from India scheme, that is the Service Export from India scheme, aims to promote export of services from India by providing duty credit scrip for the eligible export. So what is this duty credit scrip? So it is like a credit certificate issued by the DGFT, and the service providers of the eligible services shall be entitled to duty credit scrip at the notified areas on the net foreign exchange earned. So on every foreign exchange earned, so the some amount of the credit scrip will be given to you. So this can be used for payment of custom duties, excess duties, GST on payment of services, etc. So it is like whenever you want to pay the duties, so you need not go and stand in the currency exchange and buy the hard currencies. So just show these scripts and you will get the tax deducted. And further, this scheme has given relaxation to the actual user condition. So that means, so the actual user of this credit script, so he need not avail the scheme. So even any others who is not an actual user, so he can also avail this scheme. So that means I can use others duty credit script and I can deduct my taxes. And then the duty credit scripts and the goods imported using the duty credit scripts are freely transferable. So it can be transferable from one person to the other. So the same meaning we have. And then the duty credit script will be valid for a period of 18 months from the date of the issue. So it has an expiry date. And then the scheme is implemented and administered by the Ministry of Commerce and Industries. So these are the ones which I have to discuss. Then come to the last part. Friends, great people, they say that we should not see the opponents. We should see the challenge, that's it. Okay, so don't see how others are reading, how much other people are reading, how many test series they gave. So don't worry about that. So just see the challenge. That means, are you able to get some 110 marks in the mock tests? Okay, so that if you do, that is more than sufficient. So don't see others and don't get panicked, and even in the exam hall, don't see the crowd and don't get intimidated by that. Okay, so your hard work, your confidence and your motivation, so that is more than required rather than your comparison with others, especially for prelims. Okay, so do your work and break down your own records every day. So that itself will take you to the zenith. So do it. All the very best. Good luck, friends.